Time and joining us for the Alkem Laboratories Q3FY18 earnings calls. I'm Gagan Borana from Alkem IR team. Earlier during the day, we have released the financial results and the same are also posted on our website. Today in this call, we have the senior management team of Alkem to discuss the business performance and outlook going forward. Before I proceed with this call, I would like to remind everybody that this call is being recorded and the call transcript would be made available on our website as well. I would also like to add that today's discussion may include forward-looking statements and the same must be viewed in conjunction with the risks that our business faces. After the end of this call, if any of your queries remain unanswered, please feel free to get in touch with me. With this, I would like to hand over the call to Mr. Sandeep Singh to present the key highlights of the quarter and strategy going forward. Over to you, sir.
Thank you, Gagan. Yeah, good afternoon, everyone. Early in the afternoon, we have just declared our quarter 3 results and 9 monthly financial results. We have also put out a detailed press release and presentation to showcase our key highlights of the quarter. I would briefly touch upon some of these key highlights, and then we would leave the floor open for questions and answers. So for this quarter, it has yet been another strong number for us. We have more than 17% year-on-year in revenue growth, accompanied by some improvement in gross margins and EBITDA margins as well. I am pleased that this improvement in profitability has been achieved amidst challenging regulatory and competitive environment in our key markets of India and US. During the quarter, while our India business reported a year-on-year growth of 22%, adjusting for GST impact, the growth was even better. The growth was broad-based with all key therapeutic areas of companies reporting robust growth. This performance was largely led by strong volume growth and was also aided by new product launches. There was also some help from post-GST channel inventory normalization. We continue to maintain our leading position in our established therapy areas like anti-infective, gastrointestinal, pain management, and vitamins. Our chronic segment, which also performed very well with the market share gains and improvements. As for IMS data for the quarter, we are improving our ranking in CNS and neuro segment, and now we rank as the 8th largest company in India in terms of market share in CNS. Over the last 12 to 18 months, we have invested significantly to increase our manufacturing capacities. We have ventured into new therapy segments, added medical representatives to further improve our reach, and have been continuously working on various marketing and in-licensing deals to augment our portfolio. I'm happy to share that these initiatives are contributing and will further contribute to our growth in the domestic market as well as international market. Moving to international business, which contributed 27% to our total revenues, grew by 7.8% during the quarter. The growth was higher in local currency terms. Our US business, even in the challenging backdrop of vendor consolidation, pricing pressure, has performed relatively well with about 10% year-on-year growth in dollar terms. During the quarter, not only did we file 3 ANDAs with the US FDA, but we also received 7 approvals in the quarter. Keep in mind that this included 1 tentative approval. As on date, all our 6 FDA, all our plants, as on date, all our 6 US FDA approved plant facilities have an EIR with no outstanding observation, any of them. We are also investing in R&D capabilities and manufacturing infrastructure to support our growth going forward. We have filed 8 ANDAs already in the first 9 months of this financial year. We are on track to meet our guidance of about 12 to 15 ANDAs filing this year. On cumulative basis, we have filed a total of 97 ANDAs, out of which 41 are Para 4 opportunities. Apart from US, our key focus international markets like Australia, Chile, Kazakhstan, and Philippines have also recorded healthy growth. The growth would have been better had it not been for the adversely impacted currency movement. So summing up the performance for this quarter, I would like to say that it has been a robust quarter with strong all-round performance. India business delivered 20% plus growth, complemented by double-digit growth in international business. Better product mix and operating leverage helped us deliver margin improvements despite the difficult environment in our key markets. We look forward to invest in new areas of growth and we identify new evolving opportunities. We will continue to optimize our costs by driving operational efficiencies and improving the productivity of our field force. We are also continuously on a lookout for various strategic alliances and collaboration to enhance our capabilities and strengthen our product portfolio for our key markets. With all these initiatives, we back ourselves to deliver a sustainable and profitable growth going forward. With this, I would like to open the floor for questions and answers. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. Participants would like to ask questions, please press star, then 1. We take the first question from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, thanks for the opportunity and congratulations on good numbers. So just trying to understand the tax piece. I mean, even if I exclude the one-off deferred tax impact, the tax is really high. I mean, versus what we had spoken earlier, 18%. So could you explain that and what is the outlook going ahead?
Yeah. Hi, Prakash. Rajesh Dubey here. We have reported 45.6% tax for this quarter. But as you know, there is one-off element also. If we take out that, then 32% is reported in this quarter. In quarter two, our tax rate, it was around 24.5% kind of. We revisited our annual tax working and annual effective tax rate. We noticed we might be having around 2% more tax, and when it is factored on 9 months, it has resulted in increased effective tax rate in this quarter. But on overall basis, on annual basis, we are going to remain somewhere close to 27% kind of tax rate for this year.
And going forward, sir, 19 and 20?
19, 20, our expectation in revised scenario is around 18% kind of.
And what would drive this, sir?
Sorry?
How would we achieve that? I mean, I understand there's a Sikkim facility which would have tax benefits.
Absolutely. You recollect very well. This year we had some limitation taking production from our new facility. Next year we are not having any constraint of this nature. And earlier, if you recollect, last investor call, our guidelines, it was 15-16%, but still we feel will be somewhere close to 18% kind of effective tax for next year.
Thanks. And second question is on the US. So we have seen very good approvals. I just wanted to understand how should we think about, I mean, most of these have been launched during the quarter and the full impact would be seen Q4, Q1 going forward, or a large part of it impact is already felt here. That's one. And secondly, what's the outlook for next year for US where there's a lot of headwinds coming up? Thanks.
Sure, Prakash. So, in terms of number of launches for the year, now I'm talking for the year, we are pretty strong and clear on our guideline of higher single digit. So during the year, we will end up launching higher single digit number of products. Obviously, part of it has already come in the 9 months,
and part of the impact will come in the next 3 months because some of the approvals in this particular quarter were tail-ended. So that's the answer to the first question. Going forward, obviously, you know there are strong headwinds, but in terms of our number of launches, at least from a number perspective, it is the same that we think, which is the higher single-digit launches we will do.
Which are the key launches, sir, during the quarter?
We don't disclose product level, Prakash, as you know.
Okay. And lastly, on the financials, just trying to understand the capex cycle, which had increased a bit last year and this year. So what is the capex this year, and how do we see this next couple of years, and what's the debt and cash position? Thank you.
Prakash, as you know, we expected to have higher capex for last year as well as this year, and exactly it is same thing. This year we expect our capex to be somewhere close to 600 crores by year end. And for next year we expect our capex to be around 500, and I think then that is some are more closer to normalized kind of capex.
Okay. And so debt and cash position?
Right now, we don't have any significant debt, even though borrowings are there, but on net level, still it is neutral position of cash. I think going forward, our business is going to generate cash. We have to see that.
So we are net cash, if you could just quantify, sir?
There is no significant cash available as such on consolidated level. I'm talking here liquid cash. Actually, I'm not considering illiquid or semi-liquid cash position. On net level, we don't have any cash or debt. It's neutral kind of position right now.
Okay.
Prakash, just one clarification on the previous question. This is Gagan here. So when we are guiding for 27% tax rate for this year, this is adjusted for the one-time US tax, US adjustment.
Correct.
Yeah, obviously.
Yeah.
Okay. Thanks. I'll join back the queue.
Thank you. We take the next question from the line of Neha Manpuria from JP Morgan. Please go ahead.
Thank you for taking my question. Sandeep, in your opening comment, you mentioned that the growth in the quarter was partly also benefited from the fact that channel inventory levels normalized post GST.
Right.
Is it fair to assume that therefore there is some amount of lumping up of sales in this quarter which should normalize as we go into fourth quarter?
No, I just said it got normalized. There was no lumping. So in fact, if the pre-GST inventory levels for the industry was around 39, and for Alkem also it was around about the same. It has gone back to 34 days. So I don't think so there's any lumping over here. In fact, if it goes back to the real number of say 39, 40 days, then we might see a further increase in sales. But leaving that aside, I don't think so there was any lumping of sales.
Okay, so there is no one-off element in the number that we've seen.
Yes.
Okay. So how should we look at the India growth, because this year has been very volatile.
Right.
And, what is your view on the regulatory environment, in terms of pricing control, etc., as you go into FY19?
Right. So anything to predict about the government is kind of not very intelligent thing to do. But what I feel that the pharma policy, as we all know, is kind of a little slowed down. And price control also, there has been a lot of hue and cry because of the stent control. So I think the pace of control would be slow. I don't expect anything dramatic to happen next year. And coming back on the growth question, we have always maintained that we will grow at mid-teens level, and that's the same guidance we are going forward.
Okay. And my second question is, on the other expenses. If I look at other expenses in the quarter, the first two quarters, if I exclude R&D from my other expenses, were about 300 crores. This quarter, excluding R&D, that number jumped to 350 crores. Is there anything one-off in the other expenses line in this quarter?
Right. So the couple of things, and on the more detailed thing, if you want, somebody from finance will take it. OTC and marketing expenditure was, you could say, a kind of one-off for this quarter. Okay. And also because of this FDA guidelines, since we filed more than 20 products in the calendar last year, we were subject to that around $1.5 million of fees which we paid. So if you take these two, some amount of other expenses could be, make sense over here.
So then, if the OTC expenditure obviously will start tapering off from the next quarter?
It might not be lump sum, so I will not say on annualized basis it might not taper off, but yes, don't expect the same number to be there next quarter in OTC marketing expenditure.
Roughly, if you were to give me a broad sense on what these two would account, out of the, so is it fair to assume the quarter-on-quarter improvement is essentially because of these two factors? Would that be a fair assumption?
No. So what do you mean improvement? These are expenditures which have from this quarter.
Sorry, quarter-on-quarter increase.
Yes, fairly. A large part of it, more than half of increase, or in fact more, is because of these two things.
Okay. Thank you so much.
Thank you.
Thank you. We take the next question from the line of Chunky Shah from Credit Suisse. Please go ahead.
Hi. I had a question on gross margin improvement quarter over quarter. So basically there has been an improvement of 200 bips. And if you look at the product mix, India as a percentage of sales is down versus the September quarter. So what could explain the improvement in gross margins?
So it's mainly because of our product mix improvement in domestic market. So I agree that our mix of domestic business is lower as compared to quarter two, but within the current mix also, we have done well in terms of our chronic and our high margin product in domestic. So that has resulted into improvement. But if you ask about, say, coming quarters, so definitely we'll range in the 62 to 63% range only. So this may be a one-up quarter where there was a very good mix in domestic.
So when you say that high margin products grew more, are those the mega brands like Clevem and Pendi in addition to chronic, or can you just explain a bit more on that side?
Yes. So mostly those brands you can say.
So, but then those would also be growing faster, right, going ahead as well, or even chronic, for example, would be growing faster for us versus the acute piece.
Yeah, so within chronic and within acute, the product mix has been better. Like I told you that as compared to quarter two, our product mix in quarter three was better in domestic.
Okay. And on the US side, so I understand that 3Q for us is seasonally strong as well, given some products like Benzoate and others which benefit from the flu season. But if you exclude that benefit, then on a quarter-on-quarter basis, is the run rate stable?
The answer is yes. So the growth will obviously get led by new launches. And when I was answering the previous question, I said we are on target to do what we had forecasted at the beginning of year in terms of new launches.
Sure. Okay. Thanks.
Also in domestic, in quarter two, there was no major impact of price hike because the quarter one sales was very low. So what we sold in quarter two was old MRP products, and in quarter three, we actually realized a good price hike in our products. So that also impacted our gross margin positively.
Okay, so if you want to split the growth for India, or say 22% with GST impact, or say 23, 24, 25% without GST, how much of that would be price increases versus say volume increase?
So GST adjusted price growth will be around say 1%. So if you say adjust GST, I say the growth from price was around 7% in quarter three.
So 7% is a price increase you are saying?
Yeah, but if I adjust the GST, net impact was just 1%. So whatever growth we have achieved in domestic is mainly from volume after adjusting GST.
Okay, so because of the GST, the prices went down by 5%, and then the price increase that we took, hence overall it becomes a 1%.
Yes. So there was a negative price impact in quarter two of 5 to 6% because of GST, which got nullified in quarter three because of price hikes.
Right. So on an average, we have taken close to 5-7% price hikes.
Right.
Understood. Okay. Thanks a lot.
Thank you. A reminder to the participants to ask a question, please press star, then 1. We take the next question from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, thanks for the opportunity again. Just trying to understand the margin trajectory going forward. So, I mean, this year, if we see the 9 months, domestic is still lower. So, with domestic growing mid-teens, given the strong brands that we have, and US outlook improving with the new launches that you have done, how do we feel about the margin expansion, given the fact that you mentioned that there are cost-saving initiatives also being taken?
Yeah, hi Prakash. So Prakash, as you know that a business is just getting ramped up. Just stepping back, when 2 years back when we did the IPO, we said that we will get the EBITDA margins to close to say 20%, and that time we were around close to 15, 16 if I recollect. So obviously, we have kind of taken it up, but going ahead to kind of give any concrete guidance of how far it would go, when it would go, would be slightly premature, because the nature of all business is also changing with more complex generics and those kind of things which companies would want to do now. So I think what is a stabilized margin, EBITDA margin as of now, I think anything to do much more than that or in a short time frame or even medium term may or may not be possible.
But I mean, given the fact that you had a low base this year and US launches are picking up, is it not fair to assume some improvement in EBITDA margin?
It is. We cannot say whether it's fair or not, but as you also know, Prakash, there's a lot of R&D, a lot of investments which needs to be done. So I would caution you against assuming some significant margin improvements.
Understood. And what is the R&D we're looking for next year?
Around the same, sir. Around 5 to 6% every of the revenue. We would like to maintain that.
Okay. And secondly, on the domestic business, so apart from a good season we had and our chronic doing very well, just wanted to understand the new initiatives that we have taken in the domestic side. There was a press article on the MNC tie-up.
Right.
And what are the other initiatives we are taking? If you could just highlight that.
So to be honest, I mean some things will be very operational, which I don't think so merit some comment from my side on our analyst call. So what I can just tell you, sir, Prakash, what you read yesterday on the in-licensing agreement product by Alkem. We did this a couple of years back. It was already public information, and we have always maintained that we are trying to in-license products in the chronic segment particularly, because when you see some of our peers, they get much more turnover in the chronic segment from in-licensed products than what we are getting. So we are still trying to in-license some products. We in the new financial year we might float a SBU in some chronic segment. Other than that, it's nothing more. Other things are pretty operational, so nothing worth commenting right now. But we understand that we need to focus on chronic, and chronic outgrew our acute business in terms of percentage growth this quarter. So we will continue to do that.
Okay. And lastly, from a product differentiating perspective, so we have seen derms, nasals coming through this year. So would it be fair that different dosage form approvals and filings are there in place, and the quality of approvals will improve like we saw this year? By and large, we are oral solids, which so yes, one-offs we could have some other dosage forms, but nothing too dramatic. It will not change the portfolio of our products in the next couple of years. One-offs, yes, we could do some other dosage forms. Okay, thanks.
Thank you.
Thank you. Participants would like to ask questions, please press star, then 1. We take the next question from the line of Ashish Thavkar from Motilal Oswal Asset Management. Please go ahead.
Yeah, thanks for the opportunity. So my question is on the OTC business. So what's your strategy there, and have you budgeted any anything for this over the next 2-3 years, and what kind of basket are we looking to develop here?
Yeah, hi. Yeah, so on OTC, as we spoke last time also on the con call, that OTCs is a new entrant, a new business for us. It is more a wait and watch. We also want to calibrate our, business depending on what response we get, because keep in mind this is new segment for everybody at Alkem. So obviously we have some budgets allocated, but it's not something very significant. And for the next year or year and a half, we will see how this product does. In terms of what kind of products we have lined up, 2 products we already know what's there, and because we are spending, so you must be knowing what we are selling. Other than that, next year we could look at some kind of OTX kind of scenario, but it would be premature to really comment on that as of now. As I said, we will need to evaluate our OTC foray.
Okay, and any plans on how much you are willing to spend per product, or is there a holistic figure for it?
Yeah, so as last time also, sir, we would not like to disclose any amount because we avoid that. But you can make out from my cautious commentary that it's not something substantial in terms of marketing expenditure.
Okay.
Or any expenditure for that matter.
Okay, fair enough. So the India business growth guidance of mid-teens, that would be excluding the OTC business? It's a right assumption?
No, we guide for all, but OTC business is so small that if you want, you could exclude it and we'll still deliver those numbers.
Okay. Yeah. Okay, fair enough. So just a follow-up question to the early participants, like on the EBITDA margin, the expansion. So assuming that, FY18 we would end somewhere at around 17.5% EBITDA margins. From those levels, would there be some amount of leverage available with us? Given that, FY18 had first quarter, like there was a GST impact and all those things?
No, I think we already answered that. Prakash was asking exactly the same thing. So I said, we cannot expect something significant different from what we have done this year. Few basis points here and there, obviously, but nothing major.
Okay. Okay, and any color on the Sikkim facility? How's it ramping up? And
yeah, I think it's ramping up well. And Mr. Dubey, I think in his tax question, he answered that some production we could not shift to the new plant because of which our tax outgo was good. But in the next few months, please expect that a new Sikkim facility would start manufacturing on a good capacity basis.
And typically that would be gross margin accretive, you believe so?
Yeah, so you can take that.
Yeah, but actually we cater our major brands from Sikkim facility because that is for domestic. So yes, definitely we are having better margin for these products.
Okay, understood. Got it. Thanks and all the best for your future.
Thanks.
Thank you. We take the next question from the line of Abhishek Sharma from India Infoline. Please go ahead.
Yeah, thanks for taking my question. Sandeep, more of a strategy question. In the past few years, we have seen in the India market that some of your peers have used leverage to acquire, brand portfolios to grow in India. So just wanted to understand from your perspective, I mean, given the fact that there are gaps in your portfolio as well that you're trying to fill, what stops Alkem from, taking that same strategy?
Right. A good question, Abhishek. What stops Alkem is basically rational. The things are pretty expensive, and I mean, obviously there are some good deals done in the past, but we evaluate businesses and we have a strict criteria of payback because, we have reached where we have reached without any acquisition. So we are still very confident that we could build a good business without significantly spending money on filling portfolio gaps, which did not have a payback period in a particular time, which we have in our minds.
Right. But see, just on the same point, I mean, some of, at least, I mean, the highlight, it's been a mixed bag. So some of the deals have been pretty good. I mean, as you yourself said.
Sure.
And they have actually done better than, what we as analyst community could have expected, sort of them to do in terms of, improving margins, improving sales force productivity, etc.
Right.
The other thing is that, there's a tacit acknowledgement that if Indian companies are buying other portfolios, that, it's actually somewhat difficult to build brands de novo in-house. So just your thoughts on that.
No, so you're totally right. It would take a lot more time, to do it on your own. But as I said, obviously there are some good deals, but by and large, we have a philosophy that we don't want to buy things just for turnover. Because if you just even see what acquisition we have done, if you step back, even in US, we never acquired something for turnover or size. So if something's, even if it's a small brand niche, we could go for it if it makes sense. But we are not in a situation where we want to acquire brands, theoretically just to tick the box and say now we are present in that segment and we have, let's say, 5% market share of a particular segment. Because we still feel by and large what is available is pretty expensive.
Right. All right. Thanks.
Okay, thank you.
Thank you. The next question is from the line of Sion Mukherjee from Nomura. Please go ahead.
Hey, hi. Thanks for taking my question. Firstly, on the US, I think you mentioned whatever you planned, you are on track to achieve for this year, which I think is a very good achievement given what all is happening in the marketplace. Now, going forward, you have a low base, so that's a good thing. But your expectation from new launches, that would have come down, I guess, right? Is there anything that you're thinking differently for the US market given the changing dynamics? If you can share something on that.
So very strategic, broad level questions, Sion, difficult to answer on the call. But certainly everyone is evaluating the way forward in terms of either the complexity of the products or different dosage forms or anything else that we can do. And we are no different in that sense. Having said that, obviously the business still comes from a set of products, a lot of set of products, and even the earlier products as well. So we continue to grow not just through new product launches, but through key market share acquisitions in existing products as well, and that will continue for us going forward.
No, I mean you have made some derm filings. Derm is also quite competitive. You have some capabilities, controlled substances. That is also So I think the competition is rising everywhere. So I'm just wondering, are you thinking anything differently, or as of now, you are just you just continue to do what you were doing earlier in terms of your product categories?
Sion, hi, Sandeep here. So, Sion, as you rightly said, a low base would kind of help us to have a percentage growth. So, but we want to also tell you that, you yourself said that we have some different dosage form like derms and things like that. So please understand that derms is competitive today, but some few years back it was not so competitive. So obviously we try to kind of stay ahead of the curve. So you must have seen we got an onco product approved some time back. So we are thinking of some different dosage forms. We also, the so-called complex generics or tough to do products. We have them in a portfolio. If we were allocating, let's say, X amount of money on it last year, we are doing X plus something this year on those complex products. But as you know, they take their own time. It's R&D. It can happen in the right time frame. It would not happen in the right time frame. So we cannot tell you when exactly your product portfolio will start changing. But we understand what you mean, and looking at doing some in the medium to long term, getting into products which could be complex to do.
No, you had mentioned, like historically you've done almost $6-7 million per product. I'm just wondering, going forward, is that something which can continue, or you have your expectation lower on that?
Yeah. So, Sion, if you remember, historically we've said that the industry average and our target is about 5 million. We have outscored it so far, but the long term we maintain the 5 million per ANDA average.
Okay. Thanks a lot.
Thank you. We take the next question from the line of Aditya Khemka from DSP BlackRock. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sandeep, I was just listening to your previous commentary on the margin side. I'm slightly intrigued. So basically, in terms of EBITDA margins, what the point I think most participants are trying to make, that given that you had a poor GST quarter where your margins really were, dismal, and most probably such a quarter will not get repeated in FY19. Ideally, even on the run rate basis, the past 3 quarters or 2 quarters of margin that we have done in 2Q and 3Q, even if you were to sustain that in FY19, you would do better than FY18 total margins. And your response to that is that R&D cost and all, but your R&D cost you're guiding to be stable, right, at 6% of sales. So where is that extra sort of cost being incurred in your budgets that you feel that the margin expansion for full year FY18 versus full year FY19 may not be there? I'm just trying to get a better sense on that.
Right. So, you rightly said that if R&D everything is the same, then operating leverage should kick in, and
Sure.
might have better EBITDA margin. But keep in mind that we have done some capex this year, and the operating costs could also kind of go up slightly. And also please keep in mind that yes, we have a guidance of 5 to 6%, but as I just mentioned, that we are looking at doing some complex generics and those kind of stuff. Sometimes in complex generics, failures could happen, much more than what you anticipate. Things like that. So I think I would caution that. So we should have something in our hand in terms of we want to pursue some growth. So some R&D expenditure could go up. OTC again we are evaluating, and so I think it's prudent to not factor in a very high EBITDA margin.
No, so that's exactly what I think we're trying to get a sense from you, Sandeep, that given that in the past 2 quarters you have been closer to 18-19% of EBITDA margin,
Right.
and your full year you might actually end up doing 17.5 in that range.
Right.
So it's just very reasonable on our side, or just mathematically speaking, it's very reasonable that you do 18.5% next year. And which will look like 100 basis point expansion over current year, but that's just optical because for the past 7 quarters, you would have actually done 18.5% EBITDA margin.
Right.
So my question is that the risk to that you're saying is that and if I understand you correctly, the risk to that assumption is that your R&D might go above 6% to 7%. Is that the correct
Yeah,
response?
that would be better articulated. That could be there.
Okay. And also your operating costs, because you have new capacity, so your other expenses might also be higher than what we are sort of estimating at this point.
True. And also we want to under-promise and over-deliver, honestly. So
that I think goes without saying that. But okay, I get that.
Okay.
At the same time, also on the US business, and I want to pick Amit's brain on this. Amit, on the current revenue base, I think of our FY18, if my numbers are broadly okay, you might end up doing let's say $170 million sort of a business in US, right? And to your guidance of 8 to 10 sort of launches in the US market, is that your guidance?
So again, we don't split, but our number will be closer to 200 million, Aditya.
In FY19?
No, current year.
Current year, sorry. Okay. So this is, so current year FY18, 200 million is US plus?
US.
It's only US, right?
Yeah.
Okay. That's cool. And so in the next year then, how many launches are you anticipating in FY19?
Same, I would guide at 8 to 10.
8 to 10. And how many ANDAs are you planning to file in FY18?
That also remains the same, 12 to 15.
So with the 12-month or 9-month approval window from the US FDA, why should you not be able to launch 12 to 15 products if you are filing 12 to 15 products?
The answer to that obviously is that, with a 12-month approval timeline, there will be some tentative approvals as well, which because of patent situation, settlements, or even 30-month stays, the litigations, you will not be able to commercialize them.
Perfect. Now, so whatever ANDAs are outstanding before you started filing in FY18, would none of them get approved in FY19 and get launched?
So, the answer is that they would get launched. Pre-GDUFA, there is still a chunk that we have. Post-GDUFA, obviously, is reducing. But having said that, you have to always factor in mind that, 15 to 20% of the portfolio sometimes becomes commercially unviable by the time you want to launch it, either commercially unviable or unattractive. So, taking all that into account, taking tentatives into account, taking litigations into account, taking commercial situations into account, 12 to 15 filings should result into 8 to 10 launches in a year.
Fair point. I see where you're coming from. Okay. And another question from you only, Amit. On this mycophenolate infertile suspension, do we have any visibility of any incremental competitor coming to the market yet?
I think we have said that last time as well. Unfortunately, FDA does not show us who has filed and when. So we don't have any information.
Not yet, right?
No.
Okay. No, so I'm asking from the sense that, you're a person who is in the market hands-on. So if a competitor was about to launch, you would already be talking to distributors for some market share and you would hear about it. Is the perspective I'm trying to gauge from you.
So honestly, I cannot answer the question, Aditya, at this moment.
Oh, that's perfect. That answers it actually. Thank you. Thanks a lot. All the best.
Thank you.
Thank you. Participants who would like to ask questions, please press star, then 1. We take the follow-up question from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, thanks for the opportunity again. Sandeep sir, you spoke about the R&D initiatives that you are taking. So if you could just talk very broadly, what are the new initiatives that we are taking on the R&D side?
Yeah, Prakash. I mean, honestly, I'll not be able to talk much about it, but you can make out from the change of some of the approvals you have seen, like some ointments, onco product. So we do sometime try to think of products which are non-oral solids, which we think will attract lesser competition. We also think of how we could backward integrate, like have some amount of ANDAs which will have our own API. So those initiatives are on, but it would be slightly premature for me to put any number or give you a very strong indicator of what different dosage forms we'll have in the next couple of years, Prakash.
I mean, which segments, if you could just...
Segments, honestly, are your usual suspects, your cardiovascular, CNS and all. As in generic, we are not really caring which therapy area it is. So, but by and large, it's falling the same place where the market is lying. Though it could be a different dosage form or more complex product. That is something different.
And if you could just speak some broad color on the St. Louis expansion, what are the things that we are taking given the capex that we made last year and this year?
Right. So, we have already filed 3 products from there. 2 we have commercialized. And going forward in the next couple of years, we'll see far more approvals from there.
Okay. And if I remember right, we had some real estate investments sitting under investments, non-current investments.
Right.
So what is the status there? When do we plan to monetize that? Because that's the extra cash we can, monetize.
Right. So I think on the books we have around 260.
Yeah, around 260 crores.
260 crores. I think in the next 12 months we should be out of it. If we get some support from macroeconomic factors, we should be out of it in the next 12 months.
Okay, perfect. Thank you.
Yeah, thank you, sir.
Thank you. Participants who would like to ask questions, please press star, then 1. Ladies and gentlemen, as there are no further questions from the participants, on behalf of Motilal Oswal Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Well, thank you everyone for attending this call. If any of your queries have remained unanswered, please feel free to get in touch with me. Thank you.